welcome to everyone that's put the time aside to attend this forum. This has obviously been part of our program of connecting with our clients and keeping up to date with everything that's going on. My name is Simon Matter. Most of you would know who I am. I'm lucky enough to lead a great team of people that are very dedicated in delivering wealth and SMSF, and in some cases capital, and also accounting advice. So today we're going to have Jonathan Bayes, our Chief Investment Officer, speaking and leading our conversation. He'll be updating us on markets and everything that we need to know. We're also privileged to have with us as well Mark Johnson. Mark's a partner in our wealth management division. He's also the chairman of the investment committee, so intimately involved along with 4 or 5 other team members in deciding what it is that we are going to be recommending to you and how we're going to help manage your portfolios. Finally, we have Olivia Long. Olivia heads up our SMSF division. She knows everything that you need to know about superannuation, so she'll be touching on some of the key things that we need to be aware of at this point in time. So, without any further ado, I'm going to hand over to Jonathan, who's prepared an updated presentation for us. Interesting times we live in, a bit of optimism out there at the moment, and everyone's starting to talk about when we'll be returning to offices and starting to take holidays. And John will start talking to us about what that means for portfolios and more broadly. So over to you, Jonathan.
Cool. Good morning to everyone, and thanks again for giving us half an hour, 40 minutes of your time this morning. I think this is probably the 8th or the 9th one we've done, so you'll forgive me if there's a little bit of repetition. Things don't tend to change too much from a portfolio standpoint on a week-by-week basis. We're going to talk a little bit more about some Aussie companies in this presentation, as well as provide obviously an update on our views for markets and the economy, and indeed progress, if you will, on the virus. So I'm just going to try and turn this into the slideshow. Again, usual general advice warning. This is some information of a general nature, not intended to be prescribed for your individual portfolios, but hopefully a lot of what we talk about is consistent with the message that you're getting back from your advisor, and indeed from the presentations that we're sending out on a weekly basis. For the last month, in these presentations and in all of the correspondence with the client base, we continue to sort of focus portfolios on the themes of resilience, in particular, and really are focused on assets where we trust the cash flows, where we feel that leverage is permissible, or maybe that's not the right description, where we feel that leverage is appropriate and not exposed to a need for raising more equity, and focusing on the coming 12 trading months and an economy that we think will have a lot of excess capacity to it. That will likely put pressure on wages, pressure on prices. So, not to be so prescriptive, but we would fall in the camp of deflation near term rather than inflation in terms of our expectation for prices in response to what central banks and governments have been doing. And that's the themes that are informing how we're putting together our client portfolios. So there's a little bit of repetition on this slide for those of you that have heard me speak in the past month or 6 weeks, but I'll spin through it reasonably quickly. The key theme from our standpoint continues to be that there's an awful lot of debt in the world, held by different parties depending upon your jurisdiction. So in Europe, there's a lot of debt held at the sovereign level. So many of the southern European countries have got really substantial debt burdens. In Australia, there's a huge amount of debt held at the household level, and increasingly in the United States, there's a hell of a lot of debt held both at the corporate level, but also at the municipal government level. On account of the impact of shelter in place and social distancing efforts to contain the virus, we think that there is going to be excess capacity in the broader economy, remembering that services, generally speaking, make up between 85 and 90% of the Aussie economy, and it's the same in most developed nations. And that when you're less able to move around, there is a really strong drop off in the services that we all consume. So with many businesses suffering from a significant curtailment of demand, and with high debt levels, the wider economy is likely to suffer disappointing equity returns. And so we're trying again to build in that small part of the portfolio that is Aussie equities. We're trying to build a portfolio of resilience and strength of cash flows, and we feel that we're pretty well invested in that sense at the moment. I certainly retain a cautious outlook. I think markets have been driven by the liquidity injection from central banks over the last couple of months, and that's been really fortuitous for equity markets. But I'm by no means of the view that we've jumped the small coronavirus hurdle and that we're back into a bull market. So we are cautious, but I would make the point that we can be cautious, but we're still very heavily invested in the market. And so while we have high cash levels at the moment from a portfolio standpoint, almost $9 in $10 is fully invested in markets. And so we are exposed, and we've fortunately participated well in the rebound back we've seen in the last 6 or 7 weeks. The 90% economy is going to be a term that you would be familiar with if you've, as I say, sat in on these webinars in recent weeks. It will be a term that you will read about a lot in the paper in the next 6 to 9 months, because it describes, I think, very aptly the points I was raising before, which is that we are not going to get back, I don't think, to what we were pre-coronavirus from an economic standpoint in terms of consumption, until such time as we as a society feel free to move around without fear of contracting the virus. Or indeed, maybe slightly more optimistically, without fear that when hospitalised, we've got a very high rate of death. And I think there are some improvements on a couple of drugs coming through in particular, which make the outcomes a lot better for those that are hospitalised. But remembering, of course, that this is a completely new virus and one that we've only been familiar with since the start of the year. So again, that cash flow resilience, we think we'll get a premium, and that's where we're really favouring in the portfolio. And I'll refer to a few companies on the Aussie equity side shortly, and why we like them. This is a great description, encapsulates, I think, in one chart, how equity holders have been more significantly impacted, if you will, by the impact of the virus on our ability to move. And this is the ASX dividend yield chart, the forecast 12-month forward dividend yields. Australia is typically a higher yielding market by virtue of the high savings rates we've had here, also the nature of the companies being slightly more defensive in large part. And again, too, the favoritism for dividends that Aussie companies have got, given their ability to pay out franking credits as well. But you can see there that the forward outlook for dividends in Australia is as bad as it's been this century, and now under 3.5%. And a large reason for that has been the deferral of dividends from 2 of the major 4 banks, and the expectation that we could see a deferral of the second half dividends in the major banks, which I think is probably more likely than not, for a few reasons which I'll touch on later in the presentation. So pretty significant deterioration in expectations for dividend income off an Aussie equity portfolio, and that's because again, much like in the case of the banks, but also in the broader market, companies are feeling the need to have a more resilient balance sheet, so they need to have more equity held against the uncertainties that might come about in the next 12 to 18 months. And so therefore going leverage, and that just means that equity holders are suffering on account of it. A couple of other portfolio themes that I think are pertinent, and probably this speaks to a near-term description of things that I've been using in the last fortnight or so, which is that the investment markets and the rally we've seen at the moment are sort of occurring in what I would deem to be a twilight. And I call it a twilight because we're through the worst of the negative news on the economic data. I think everyone's really au fait with just how significantly the economy has been impacted by shelter-in-place orders here in Australia, but also too in the rest of the world. And so that bad news is now really well known. And from these incredibly low levels, the only way is up as we slowly start to re-enter society, if you will. So people are talking about, you know, improvement on a month-on-month basis, which is absolutely fair. We've also got positive news flow in the very near term in terms of the efforts of the quarantine process on restricting infection rates. So we have flattened the curve in a global sense in many of the major jurisdictions around the world as well. And we've also got this ballast to the local economy and indeed to, you know, economies in Europe and the United States from government relief efforts. So in Australia, we've had the JobKeeper, our program. We have a far more generous program in the United States called the Paycheck Protection Plan. And so you've got a heap of workers who are obviously having a very tough time of things being furloughed or laid off permanently, being provided with payment checks, etc., to ensure that they can pay bills and go about their day-to-day consumption as best as possible when restricted from work. And so it's a twilight at the moment in the sense that there's no more negative news coming through, and arguably on a month-on-month basis we're improving, but there is the potential, I think, still very much so, for darkness ahead of us once the government stimulus packages end, and in the United States that's at the end of July. Which is a little sooner than Australia, although it does feel like in Australia anyway, there's an ongoing debate about how JobKeeper extends. But at the moment, that's to the end of September, and that's when the banks have also agreed to provide relief on mortgages to the end of September. So that's our big cliff point, if you will. And we also have the threat, which I think is still very real, of a second wave, if you will, of infections. We have done a terrific job in Australia, and I think we'll probably continue to do a really good job as well. But the risk, obviously, in winter is that we will get outbreaks. And in the United States, you know, where they haven't been probably as consistent as other parts of the world with their quarantining, we still have you know, over 20 states that the CDC in the US still deem to be uncontrolled in terms of spread. And we've seen a very significant number of states reopening at the end of April, start of May. And the risk is that in the coming couple of weeks, we start to see infection rates escalate and potentially to see hospitalizations, which are already starting to creep up in a few places, creep up to levels where it might become concerning again, and where we might need to see local governments again force quarantining on the population. Elsewhere in the portfolio, you know, we continue to be very much of the view that international equity holdings will provide excellent returns. They provide much greater diversification than the narrow Australian market here. Again, those of you who have heard me say this probably dozens of times before, but the Aussie market is less than 2% of the global equity market. But we really want to make the point that we've had supernormal returns from international equities in the last 5 years, and a large part of that has been the fall in the Australian dollar. And we think the Aussie dollar is bottoming out, and you know, it's pretty strong again last night, pushing up to almost 67 cents. And I think it'll probably see 70 cents in the next month or so. And so if the Aussie dollar is bottoming out, then a large source of those excess returns will not only diminish, but potentially start to go the other way. And so we tried to mitigate against that in some way by hedging a little part of the international exposure we've got, but also to try to avoid as much as possible very heavy Aussie dollar exposures on our Aussie equity portfolio as well. The last point there, I think, is really pertinent. You know, that 9% return over 5 years from the MSCI World in Australian dollars is exceptional when you compare to the local market return of 3.5%. But you'll note that the MSCI World in US dollar terms is under 5% annualized return. So, you know, really almost a doubling in the return, and that's all from the Aussie dollar falling from parity against the US to where it is today, as I say, 66, 67 cents. And the reason the Aussie dollar is bouncing is because we've got a normalization in China. And so demand for our exports has normalized really quite quickly. 30-35% of our exports go to China, and a huge amount of them is in the form of red dust, iron ore. And you can see there that we have a record trade balance in March, and it's likely to be very strong again in April. So that's one reason. And the second, I think probably even most important reason in the very near term, is that we are not stimulating in Australia anywhere near the extent that they are stimulating in other parts of the world. And so the red line there is just money supply growth in the United States, which is growing at an annualized rate of 18% per annum. So when you just think of the economy itself is growing, you know, in a normal year, 3-4%, maybe in a better year, between 4 and 5%. In the United States at the moment, money supply is growing 4.5-5 times that. And this is again digitally printing money with a view to providing liquidity to financial markets and indeed to companies, etc., to stop unnecessary insolvencies in the United States. And here in Australia, as you can see, we have started to stimulate. Our money supply growth is running at 4.5% a year, but the white line you can see is significantly lagging the US. And so like any market, currency is no different, supply and demand rule. We're just not supplying Australian dollars to our economy in nearly the manner that they are in the US or in Europe or in China, etc. And that is causing the currency to drift higher. And I think that will continue for a few months. My expectation is as we get deeper into 2020, the Reserve Bank will be forced to stimulate more aggressively. But at this point in time, they're hopeful that the government will provide further fiscal stimulus to protect the economy. But at this point in time, as I say, I think we'll see the currency at 70 cents before we see it back down at 60. The other description of the previous chart, which is in this chart, which again you might remember from a fortnight or so ago, this just shows real interest rates. So these are inflation-adjusted interest rates in Australia. And the orange line just shows the difference between our real interest rates and those in the US. And so you can see the orange line. All you need to really know, guys, is the orange line is heading higher. That means that Australian real interest rates are pushing higher than those in the US. And that's because of the reasons I just cited before, that, you know, we're not printing as much money as they are in the US. And the white line should follow the orange line higher, which is the Aussie dollar. Hopefully pretty simple to understand. Other themes that we're looking at, particularly in a time of zero interest rates, you know, how do we find a steady source of income? And whilst we've got concerns over the housing market in Australia, most definitely in the very near term, we're not expecting a housing market crash by any stretch. I think the base view that I would have at the moment, but it is a moving feast, is that we'll see a 10 to 15% fall in residential house prices, which is not unlike what we got in 2018 and early 19 through the impact of the Royal Commission on lending and the impact that had on housing demand. With a 10 to 15% downside in house prices, we think that'll be well handled by the economy, and we think that those companies that provide debt finance to the housing market will do well. So La Trobe continues to effectively do what the banks do, that'll be delivering at the moment 5% type income. Again, in a world of zero interest rates, I think that's pretty attractive. Again, typical loan to value ratios in the low 60% range are more than defensive enough to accommodate a 10 or 15% house price fall. First mortgage debt that Qualitas and Metrics, and for those of the wholesale investors, CVS Lane and Merrick's Capital provide to property developers, we think is certainly higher risk than what La Trobe are doing in terms of individual mortgages. But we do think that, again, with very significant protection in terms of the equity buffer, if you're lending on a 60% loan to value, achieving interest rates of 8 to 10% is fantastic risk reward. So they are certainly areas of the market that we believe can provide good, really premium income in a world of zero interest rates. It's hard to be overly optimistic about government bonds when you've got bond yields in Australia at 25 basis points, where the RBA is buying them, and about 90 basis points for 10-year government debt. But if we need further stimulus, which comes later in the year, potentially, I think, from the RBA, as I flagged before, we could actually see Australian government bonds rally further. And interest rates on Aussie government debt head closer to zero. So it's a tricky time to get solid income in your portfolio, but we do think that a few of those first mortgage providers in particular are a great way to achieve what we think is really good risk-adjusted income returns. So on the Aussie equity themes, I don't tend to talk about these things overly much. But again, back to cash flow resilience, the names that we've got there, hopefully many of you will be familiar with in your own portfolios. Amcor, the packaging group, has done really quite well in the last 3 or 4 months, barely affected by the shelter-in-place orders, because they're packaging things that we consume day in, day out, whether we're moving around in the economy or not. Nufarm, again, has got its balance sheet in great shape, having sold off the Latin American business to their major Japanese shareholder, and now has a pretty decent balance sheet and benefiting from the rains we've had along the East Coast. Telstra, again, pretty dull and boring, and if you're like me, you've had to deal with Telstra in recent weeks, you'll find them completely frustrating from a consumer standpoint. But the business is big and big and ugly, but super defensive, and will pay out a 5% fully franked dividend yield. Will benefit, I think, from the consolidation we're seeing in the mobile market, and I think as you look into 2021, there'll be a lot of discussion about floating off the NBN, and Telstra is likely acquirer of that. Well, arguably merged their infrastructure business in with NBN, and I think that'll be accretive for shareholders. And then the other names, again, I don't want to dwell hugely on these. It's Spark Infrastructure, a big electricity utility play. They've got just under 50% of the distribution grid here in Australia and in South Australia, Victoria, I should say, and in South Australia. So that's a consistent 6.5% to 7% dividend payer. InvoCare, which own over 30 or 40 funeral brands here in Australia. Pretty consistent business. They've been impacted by restrictions on the number of people at funerals here in Australia, and definitely in New Zealand, where they basically banned congregations in totality on funerals. But as we're now easing that up, it's a pretty persistent business, and trading as cheap as it's done in 5 years. Coles, you all know, great balance sheet. Again, sales have been terrific and will continue to be so. And then two companies that maybe you'd like a little bit of description on, but we think are great long-term growers and with really good consistency in their cash flows. NextDC is a big data center company. So if you think about cloud computing and the amount of data that needs to be stored, NextDC is the dominant player here in Australia. And we think that that's got a lot of upside in it over the next few years. And then Altium is a software developer, and they sell design software for integrated circuits. So if you think about, again, connectivity and the number of devices in the home, and in your automobiles and the like that are increasingly connected to the internet or interconnected amongst themselves. Altium provides software design tools for engineers to make integrated chips. So they're a great long-term story, we think, with a really strong market share that will do really well in the next few years as well. The other themes, we've been scaling down our small cap exposure, and I'll show you a couple of pictures in a minute why. Small caps have really outperformed in this market rally, and you know, I wouldn't have expected it to be as strong as it was, because small caps do tend to be more economically cyclical. We think growth stocks look really overpriced relative to what we've deemed to be value, and I'll show you a couple of pictures in a minute. And everybody asks about banks. We've been underweight these things for 5 or 6 years, where we've taken a little bit of the underweight back, but we're still about 30 or 40% underweight, mainly because we're right in the middle of the storm for the moment on the banks. They're doing a huge amount of the heavy lifting on mortgage and rent deferrals. Their share prices reflect a lot of this, but you know, there is the risk that that as we get to the end of September and we see the whites of the eyes of the economy and the impact that that's been borne on the economy, that the banks might have a final leg lower, at which point we probably look to be more aggressive buyers into 2021. We do think, I certainly think that it's highly likely that having ripped off the band-aid on their first half dividends, that there will be a deferral on second half dividends from ANZ and from Westpac. And if not NAB and CBA, they'll be very, very diminished. We're looking at a whole variety of new names, many of which will be familiar to you. I won't go through them all in detail, but again, a focus on quality and the same things that I flagged earlier. The presentation gets a lot quicker from here, guys, because we're moving into the charts. But you know, on the left-hand side, you've just got some valuations of small cap, mid cap, and big cap. And it demonstrates just how much the small and mid cap part of the Aussie market has squeezed relative to the big cap. Now, you might say that makes a lot of sense, because the small and mid caps have got a lot of the tech and growthy names in them, and the banks are in the big cap part of the market. That as I say, is probably true to some extent, but you can just see the size of the outperformance. And you're now paying a higher multiple for small and mid cap shares now than you've done at any point in the last 10 or 20 years. And I think that, again, everyone's got to remember that the price you pay for something has a huge impact on your future returns. I don't believe that the outlook for earnings over the next 12 to 18 months remotely justify the valuations people are paying for a variety of shares. And then on the right-hand side, you can just see the disparity between the performance of small caps in Australia and compared to small caps in the United States. And so for the better part of 2 years, they've mirrored one another. And then look at that massive gap that's opened up on the right-hand side of that chart, with the red line being the Australian market smalls or big caps underperforming small caps. That's a way to look at that, compared to in the United States, where it's been broadly pretty steady. I think that that's going to reverse, and our portfolios are set up to reflect that. The next chart that our portfolios are set up to reflect is just the huge disparity that's opened up between growth stocks and value stocks. So value stocks tend to be old economy cyclicals, you know, banks, oils, miners, but also two broader industrials, supermarkets, retailers, you name it. The growth stocks tend to be biotech, technology, and the like. And so when the outlook economy has been threatened, you've had, you know, many of the big tech companies in the United States in particular arguably benefit from what's occurred with shelter in place. You know, the whole world is crowded into those big NASDAQ names in particular, but also too in Australia and some of the tech names in the small and mid-cap sector I've just flagged. And now you've got a valuation gap that's opened up, which is as wide as it's been on a couple of measures in 50 years. And I'm happy to furnish anyone with the studies that I'm referring to there after this. And again, it's important. And it's really important, actually, when you watch share prices go up in the manner they have in the last month or two, that you've got to remember that the price that you pay for these things is a huge determinant on your future returns. Quick update on the virus. It wouldn't be right to do this presentation without at least sharing with you a few things that we're watching. This is just a chart of various states and where they are in terms of infection rates. You don't need to worry about the lines at the bottom there, guys. It just is a state-by-state case. The red line and the shape of that red line is the relevant one, and that is just the number of infections in the United States, excluding New York and New Jersey. And what we want to see there in that red line is it flattening, and it's not. That's all you want to see. And you can see from the white line, which is New York underneath it, that's flattening. But in all of the other states in the United States, and this is the reason why the CDC continue to say it, there is over 20 states that are yet to control the virus. And you can see the red line is not flattening. So that is something that I think is pertinent, particularly given that we're reopening in the United States. The next chart is my reopening curve. And again, I won't go through all of the various lines on it. I'm more than happy to share the presentation with anyone who wants it later. But what we want to see in all of these lines is the lines flattening. And at this point in time, it's hard to make a call, but I would say that the obvious lines that are at the top, the purple and orange line, that are relevant there. The purple line at the very top, I think from memory, is Alabama. I think it's Alabama, but again, no flattening in that curve at all. And what I'll be watching in the next couple of weeks is whether A, it flattens, or more likely, those charts start to steepen. The base state that we've taken there for every one of these charts, every one of these lines, I should say, is from their reopening date, and that's why some of the lines are longer than the others. And then again, the real, sadly, concern at a humanitarian level is just the impact that the virus is having in many of these emerging markets. So the yellow line there is Brazil, and we've been warning on that for a few weeks now. And the blue line is Russia, and scarily, the orange line is India. But in many of these countries, they're simply not doing enough testing. So the concern is that that these numbers could continue to spiral a lot higher. This is a little bit of a repeat on the last couple of weeks, but I really think that it's pertinent. This is an updated Australian leading indicator that Westpac put out every month. And the reason I bring it up is just to give you the context. I mean, this is a measure of economic indicators coming out that Westpac put together into an index, and it just shows where it forecasts our economy to be going in the next 6 months. And you can see that it's as bad as it's worse than it was in the 1990s recession, or worse it was in the 2008 GFC. And again, I'll touch base on the reasons why shortly. This is the weekly confidence numbers out from ANZ. We've definitely down. I mean, this data doesn't go back the way that the Westpac data does, but we've definitely rebounded it back. But you can see we're still a long way short of where we were entering the lockdowns in March. A long way off. This is an update on building approvals, which I really think is a really important thing for us all to consider, and it might give you some context as to why we're seeing the Housing Industry Association pushing for fresh stimulus. It really is a big part of our economy. 10% of the labour force is employed in construction. The white line here, guys, is new orders for housing, so both private houses but also apartments. And the red line is building approvals for private homes, and you can see that they track one another pretty closely. Supply and demand is what it is. And the red line, unfortunately, I think is set to fall a lot further. And Fletcher Building last week made it pretty clear that they're expecting about a 15% fall in construction activity. We've got anecdotal evidence from a few of the partners that we've got at Prime that are really suggesting that on the big commercial construction projects that there's been a real slowing in tendering, and that there are many jobs that are coming up for completion where the worksite crews have not got another job to move on to. And this was all happening well in advance of the coronavirus as well, which is the concerning thing. NAB business confidence in white, and NAB business conditions in red. Again, just to put it into context with how our business leaders and small businesses as well are seeing the world. And this is again the main point on excess capacity. And unsurprisingly, when you've got excess supply in the jobs market, wages fall. And so the white line is unemployment and underemployment. So it's 15% as of the last data for April, but I think it's going to end up higher in May. So 15% of the labour force is underemployed or unemployed. And the wage number has just been inverted there. You can see on the left-hand side, 2.1% is the last annual wage growth figure. It follows the white line quite significantly. And again, I would fully envisage that we'll get wage growth, sadly, at the lowest rate this century in the next couple of months. And it's probably likely to be 1.5% or less, which is concerning. The other thing too is that these numbers are actually flattered by the fact that a whole heap of people actually exited the workforce in the last couple of months, and so the participation rate has collapsed in Australia, and it just means that in actual fact that 15% underemployed and unemployed of the labour force is flattered. If we had consistency in the number of people that were still looking for work, that figure would be a lot higher. In fact, it would be just short of 20%. Just to round a few things out, again, this chart I included in the presentation a fortnight back because I just think it's really pertinent. I mean, there's no getting away from it. Rental vacancy rates have skyrocketed in all of the major cities around the country because, again, many of the foreign students aren't coming back in the near term, and also because, sadly, the whole a heap of millennials have handed the keys back and foregone their deposit and gone back to live with mum and dad, and that's not a great thing from an economic standpoint at all. And again, not to be too negative, but I think just to be realistic, the hardest thing that we've faced now as an economy is that we need a fresh stimulant, and we had lots of them back in the GFC, and that was why we sailed through things. But regrettably, we're sort of lacking in a fresh stimulant. The currency, the interest rates, the fiscal stimulus, I think, will be the main lever. But again, we're not in the position we were in 10 years ago. And as I say, China's not going to bail us out to the extent that they did back in the GFC either. So we're sadly lacking in fresh stimulus. And then just 2 points, because I know that it's going to come up, and then this is me done. And this is this point about the investment market being in this twilight where there's a huge amount of optimism in share prices, but I would argue there's not a huge amount of real world optimism. So the first point on the real world is just to take US earnings per share estimates from analysts. And you can see there that I've got this year, next year, and the year after, and I've also got the historic earnings per share in purple. And you can see the downgrades that analysts have taken to forward earnings estimates over all of the years. Obviously, this year is the most significant one. But you can see there that there's been no improvement. Analysts aren't sitting there going, you know what, I got too negative, I was too bearish, we should be upgrading our numbers now. Things are looking more optimistic than I gave credit. There's no evidence of that at all. Share prices obviously have rebounded hugely. But the next point that I would make, just again in terms of just how extreme we've got, on a slightly related but unrelated point, is just to show how extreme the price movement has been in certain parts of the market. And so this is a picture of the NASDAQ share price chart in one of the biggest bull markets in history, the last 10 years since the GFC. And the lines that you can see on the share prices there are just simple regressions, which is just to show a trend. And the red line is just the median of the trend. And the white or the grey line and the green lines are just the deviations around the trend. And I won't go into too much more detail of that, but as a general rule, most observations in a trend or any data set tend to land within 2 standard deviations of the mean. And you can see by the little white candlestick at the far right-hand corner that we're poking our head up above that high green bar, and it just makes the point that we're actually now in the US in the NASDAQ trading 3 standard deviations above the mean of what has been one of the strongest trends in share market history in the NASDAQ the last 10 years, which is basically a 1 in 300 occurrence. But you can see that from the top right-hand corner, that 1 in 300 occurrence has happened 3 times in the last 5 months. And I think that really speaks to just how extreme the share price momentum has been. And it's very difficult to sit here today and say, you know what, after a really strong 10-year thematic playing out, that this trend is actually going to steepen and we're going to actually push share prices significantly above here, I think is really, really difficult to justify. And I think that this is probably one of my favorite charts. It might be slightly quirky and technical, but it's actually one of the charts that really puts share prices into context for me and shows just how overbought or extended the share price action in some parts of the market in particular has been. And when you compare that to the underlying earnings I just showed you before for the S&P, you can see that there's a real gap that's widened up between expectations in the share market from a price standpoint and the expectations from the perspective of underlying earnings that these companies are delivering. Anyway, I'm not sure, I haven't got a clock in front of me, but that will end it for me. Hopefully there's been a few different things in there, and I might hand over to Olivia.
Fantastic. Thank you very much, Jono. And good morning, everybody. I'm going to talk for about 5 minutes on super, not just today on super and COVID-19, but on year-end planning, given that we are heading towards the end of the financial year, and it's time to get your affairs in order. So let's start with the 3 key themes or relief measures that the government extended around super. The first being the $10,000 early access to super scheme. So this has been extremely popular among Australians who have been able to access $10,000 from their superannuation between now and 30 June, and a further $10,000 from their superannuation between the 1st of July and the 24th of September 2020. So for people that basically are either unemployed, for people that are on job seeker, or people who, youth allowance, who are on job seekers, people who are receiving parenting payments, or those who after the 1st of January have been made redundant, have had their working hours reduced by more than 20% or more, or for business owners that, or sole traders that have had a reduction in their business turnover of 20%, are all eligible for this $10,000 early access relief. So if you haven't done it already and you intend to, then you need to get onto it because you've got 1 month left really for the first early access. If you have a self-managed super fund and you're drawing down that amount yourself, then you actually need to speak to your accountant. There is a minute and a compliance template that you'll need to fill out to satisfy compliance around it. If this impacts on you, feel free to contact us. We have a template we can provide you with. The second measure of relief is around pensions. So pension minimums have been halved, not just for the 19-20 financial year, but the 2021 also. So for many people who haven't drawn their pension minimums yet, revise what you actually need to withdraw from your fund at this point in time, and you can reduce that amount. But it's important to note that if you have already drawn your pension minimum for the year, you can't actually put that back into your super unless you are eligible to make contributions back into your super fund. The third key measure is rent relief for related party transactions. So where people are running a self-managed super fund and are leasing business real property from their self-managed super fund, there is an eligibility to have a rent relief period. But you will need to speak to an advisor or your accountant about the terms and conditions around this. There are conditions, and again, there are compliance requirements that you'll need to satisfy in documentation in order to use this relief measure. At this point in time, other key things to consider that we recommend are stopping and restarting your pensions. So for those of you that have a pension and there are no adverse reasons not to, you can actually stop and recommence that pension now while your portfolio value is at a lower balance. And obviously this impacts predominantly on people who have satisfied the one or have met the $1.6 million pension cap threshold. It's prudent, and many people don't realise that they need to hold a death benefit nomination on file. This is basically because your superannuation is not automatically dealt with as part of your will. So if you have a death benefit nomination, we consider reviewing review it at this point in time, make sure it's up to date and it's also valid. And we also strongly advocate, if you don't have a will, please speak to us. Everybody should have a will and have their affairs in order at all times. Other things to consider between now and 30 June are maximising your contributions. If you have additional cash at this point in time, which some of you may, then you do need to speak to your advisor about your contributions so that you can maximise those thresholds. And the other one is contribution splitting. So sharing out contributions between you and potentially your spouse to try and equalise the balances. And again, this is because of the $1.6 million pension cap. So if you're able to, you need to organise your contribution splitting prior to the end of the financial year. So in terms of super, that's me. At this point, I'm going to hand back to Simon Matter for questions and answers.
Fantastic. Thank you, Olivia. Thank you, Jonathan. Just we have not just Jonathan, Olivia, but also Mark online. And we've actually already had our first question submitted prior to today's session. So that's from Donna. And I think this is one that, Jonathan, you would be best to address. But Donna's asked us about the direction of the Australian dollar versus or against the US dollar. Is it heading up or down? What's the current rate? And within the next 90 days, when do you expect the rate to be best for converting US to Australian dollar? So that's from Donna. And I'm going to ask you to put on your futurist hat, Jono, and give us an opinion.
Well, hi, Donna. Listen, I think the currency is definitely pushing higher. That's the view that we've got. We've had that view for a few months now. So I would say, you know, as I say, we'll see 70 cents in the next couple of months. But I mean, calling in something in the next 3 months, Donna, is very, very, very difficult. So, I mean, I would be speculating, and frankly speaking, you know, my speculation might not be worth any more than anyone else's because it is such a short time frame. But in the near term, I think the bias is higher, you know, I think we will see 70 cents in the next couple of months. So I suppose that's in the next 6 months, maybe is a better way of putting it. I wouldn't be so confident in the next 3, and I wouldn't expect to see the Australian dollar in the low 60s in that time either. I think the bias is up. I think that there's much greater likelihood that the currency becomes a problem for the Reserve Bank this year. And that they have to take steps to address that, which ultimately, along with the economic weakness, bring the currency back down. But I think that's at the earliest a Q4 thing and maybe a 2021 thing.
Great, thanks, John. Next question here from William Prentice. So William's asking us about the risk attached to a possible Cold War between the West and China, perhaps as a result of calls for COVID investigation, e.g. China already making threats against Australian exports. Also, what are your thoughts on the outlook for the price of oil? And Williams thanked you for the presentation, what you've covered off. So now's an opportunity to give us another opinion, Jono, and view.
Well, Mark, I'll take it unless you want to come over the top at the end. Maybe I'll do the start. I think there's a risk. It's really hard to probability weight these risks when you look at portfolios because, frankly, William, a lot of these risks exist, you know, on a day-to-day basis. Anyway, I mean, we were worried a year or so ago when the Saudis were being bombed out of Yemen, and you know, we've worried on an ad hoc basis about Iran and North Korea for years. But overall, I think the tensions between the US and China are very real, and that they are not going away anytime soon, even if we get a change in president, because the way that the two nations in particular go about things is is very different, and it's likely to lead to the loggerheads that we're seeing. Unfortunately, what it means from a market standpoint, is yes, that there'll be slightly higher risk to markets, which we'll all have to compensate for. But really, in the medium term, the biggest problem is that companies have really benefited from globalization in the last 20 years. It doesn't mean necessarily that all humans have benefited from globalization, although I would say that in the vast majority of instances, people have benefited in the developed world in terms of cheaper consumer goods and the like. But when we see the two countries going head to head over issues of technology and security, it just means that more product is going to get made in each country's home country. And the fact of the matter is, in the United States, they can't build things as cheaply as they do in China. And in China, they can't get their hands on the technology that they have in the US. And it just means that the cost of doing business is going to go higher. It's going to be less efficient, and that ultimately will have an impact on profit margins. So that would be the way I would couch my answer to that question.
Thanks, Jonathan. I might actually now just take the opportunity to bring you in here, Mark. And particularly in the last 2 or 3 months, we've been proactive with some of the portfolio changes that we've made for clients. And we have a lot of clients that have a direct relationship and make the final decision on particular investments. But just talk us through what are some of the more difficult concepts that you've had to address with clients, in particular on specific stocks. And maybe you can also comment a little bit about our current focus on trying to find those stocks or those positions that can deliver better income outcomes. So maybe if you could just comment on those couple of things, that would be helpful.
Yeah, look, I think that everybody who's got investments appreciates that coming into this, it's a black swan event. No one saw the virus coming and to have the impact that it has. So I think by and large, most people's attitudes, has been and continues to be that we're all in this together, and that we need to ride it through the best way that we can. And I think that's, maybe a little bit different from the GFC when there was other things at play, but this is certainly that an event or it's a virus that's caught everyone by surprise. So I think there's, and with that comes a certain resilience that comes into people's attitude with their portfolios. Yes, I know it's down, it's taken a hit, but I'm going to ride this through. And that's what we're advocating. We're thinking that, we've got portfolios. We're mainly dealing with self-managed super funds. We're investing for the medium to long term. And we're not looking at a 3-month view or 6-month or 12-month view, and we're looking to ride things through. That said, the start of the year and markets leading up to this period have been pretty strong. We saw markets in January are up 7% for the month, and things were pretty bullish. Not unsurprisingly, we've spent a lot of time in the last couple of months talking to people not only in equity markets but in debt markets, and a lot of the conversation has been that things were pretty competitive. From pricing point of view, there was, and a lot of this has come about because of the underlying thing that virus is one, but the underlying biggest impact on portfolios is the fact that we've got interest rates at 0.25%. So that flows through to all returns across all asset classes, and that's the thing that has the biggest impact. So when we start to bring that back to portfolios, it's there's a couple of things when we've taken a hit, not just to the domestic economy, but to the global economy, that you need to look. We've been looking at, and we've tried to be proactive with businesses that have a higher degree of cyclicality, or they have more risk to their business. And that also includes looking at businesses that are carrying a higher amount of debt or got more leverage on their balance sheet. So these things are obviously, when things are going well and that trend is going your way, perform really well. But when the economy and markets get a bit tougher and it's harder to generate profits, then any premium that was attached to their share price or multiples in terms of PEs tend to come back. So that's where we've tried to be proactive with portfolios and say, look, these things, and they're going to take a short-term hit, yes, but longer term they're going to struggle as well because they just don't have the same flexibility in terms of the balance sheet to recover. And I guess where we've the focus has been, because we are looking at self-managed super fund, we are, and many of our clients are dependent upon this to generate an income to put food on the table, is to come back, and I think Jono used the term a couple of times during the presentation, in terms of cash flow resilience, because we all know that dividends are paid out of cash flow, or we like to think that they're being paid out of cash flow and not borrowings. Or another way to say the same thing is, companies with more defensive earning streams. And we did speak to that earlier in the presentation. Jono was talking about some of the latest recommendations. Now, whether that be a business like NextDC, which is cloud computing, and it still trades on a high multiple, and they're very much in the growth phase, or whether that's a Coles, and that cash flow resilience is still the key point, because it's a sought after product. It's essential to the economy. So whether it be staples and groceries, or whether that be data, and data is now essential, even more so that we're all operating through Zoom and working remotely. Information flow has never been more important. All businesses like Altium, where we are more and more living in a world where we're more dependent upon automation and computers and technology to improve our systems and the way we do things. So this cash flow resilience or defensive earnings has been a real theme, and that's where we've really tried to get portfolios both in the separately managed accounts and directly, because we feel we've got the same issues. So markets and how they're traded and what kind of multiple will ebb and flow, but we think we're probably coming into a period where the economy's had been in a pretty strong patch. Things are likely to be tougher with just unemployment rates being what they are. The economy's not going to be the same, and we want to be in quality companies where we can ride it through, and importantly, still generate an income for portfolios.
Yeah, well, that makes complete sense. Thanks, Mark. And just if there's no other questions from our audience, I might just quickly throw to you, Jono, for the last question, which just simply is around, the Australian government had a bit of a wobbly week, maybe a couple of accounting errors, and someone didn't hit the right button on the calculator. But just when you take a step back, how would you rate the Australian government's performance? And a little bit more about the position that Australia might hold. And I think you've said multiple times you feel it will come out of this better than most. But just talk to us about maybe who else you think will come out of this in hopefully equally as good a position as what Australia might as well. So just a bit of framing up for that would be helpful.
Well, listen, you've given me a bit of a soapbox here, because I think everyone has their own opinion on things, and frankly, again, I would say my opinion is not worth any more than anyone else's. But given you've given me the soapbox, Mads, I would say I think we've done a really good job. But we've once again been blessed by the natural geography and the fact that we only have 26, 27 million people in a country of this size. We don't live on top of one another, which has certainly helped the rate of infection spread be less than it was in other places. We can seal our borders, which helps, but we did do a good job of that. There's no doubt about it. I think the cohesion between the federal government and the states has been pretty good. Ruby Princess and Dan Andrews, criticisms aside, I think they've done a pretty good job. I think the other thing, which again, frankly, I think is a really fortunate thing for us as Aussies, is that we've got a respect for government. And I was going to say a compliant population. I don't know that actually is the right way to describe us, but the problem that they've got in the United States at the moment is just this, regard for liberty, and this disdain for science. I think is another thing in certain parts of the country, and you can see in Australia and Canada, we listen to the government when they tell us to do things. You can see it all through Asia, and that means that we're in a position to come out of the quarantine quicker because we're all going to obey in large part what it is that the scientists are telling us. So I think we've done a really good job. Just to comment on JobKeeper though, my response on that, and to be really honest, I haven't gone through it in huge amounts of detail because, for a large part it's done what it's done. And as I say, we're in this twilight where we're just sort of throwing around large numbers. And so I guess what I'm saying is for the market itself in the very near term, it's not been a major factor, and it probably won't be a major factor for the economy on the other side anyway, because it ends in September. But it's $60 billion less spent on protecting people than they said. And so when they were touting it to be 15 to 20% of GDP as a stimulus, it's now half that. So it clearly isn't protecting as many people as they thought. And that obviously means that the burden will be borne on household balance sheets by $60 billion more than we previously thought, and less on the government balance sheet. So it would be good if instead of seeing this as a saving, I think given the current economic situation, it would be good if they found a reason to refocus it on a way to stimulate the economy because of the issues that we've got coming up.
Yeah. All fair. Thank you so much. I'm conscious of time. We've now hit 10:32. So we've had a great turnout. Thank you to everyone who put the time aside to listen to our update. And of course, thank you so much to our highly educated, intelligent and experienced panelists, Jonathan, Olivia and Mark. Thank you for all your commentary. We hope you join us again in 2 weeks from today. This is our regular slot. And in that regular slot, Olivia will be back hosting. So thank you for taking the time and have a fantastic rest of the week.